Good afternoon, everybody. Welcome. This is an event for The Hub, which is a think tank essentially at Columbia Business School focused on research in key areas, on curriculum development, and on conversations with thought leaders. I'm Glenn Hubbard. I am supervising part of this hub, which is on business and society, in an agenda on the future of capitalism. And this is one of the discussions in that regard. Joined today by Oren Cass, who I'll introduce properly in a moment. There is a chance for all MBA students to get involved with the hub. There is a student advisory board. I'm told applications are due October 9th. So if this kind of thing interests you, by all means, lob in. So today we're going to tackle a big question, but hopefully with some specifics. So we'll be partly at 10,000 feet and partly on the ground. A question about whether capitalism is working, and it's a conversation with Oren Cass. Many of today's public policy and business debates about capitalism go back to whether there should be continued relevance of classical liberal ideas, think Adam Smith, or neoliberal ideas, think Friedrich Hayek or Milton Friedman. Our guest today is the founder of American Compass and a former senior fellow at the Manhattan Institute, and Oren's been a real contributor to this debate. He wrote a book that I would commend to everybody. I don't agree with all of it, but I do agree with part of it, and we'll try to talk about that, called The Once and Future Worker, a vision for the renewal of work in America. I expect you'll hear both of us talk a lot about work and the centrality of work in our politics. In leading American Compass, Oren and colleagues are involved in what a new economic policy agenda might look like. I'm not sure he's a fan of neoliberals. I'm not sure he's even a fan of economists, but we'll find out. When Oren and I finish a conversation up here, there's plenty of time for Q&A. I'm told index cards were distributed, so to make it faster and get more questions in, write your question, get it to the aisle. I'll have them, and I'll go through as many as I can before we stop. So, Oren, welcome. Thank you for coming to Columbia Business School.
Well, thank you.
So, let me start with just a really big picture question to tease it out. What does it take for markets to work well? And in your view, have economists or business people just put too much weight on markets or laissez-faire in recent decades?
Well, I suppose this is sort of the obnoxious answer that it depends what we mean by work well. But I think it's actually the central question and goes to the broader question of, is capitalism working? You know, I think in economics class, to a significant extent, when economists are studying markets, the question of whether they're working well is whether they are working efficiently, meaning are they allocating resources in a particular way, and typically in a way that is going to maximize consumer welfare at the end of the day. I think the problem is that we want a lot more than that out of markets. And you mentioned work as a great example of this. One of the other things we really need markets to do is create good jobs. We need a market economy that is raising consumer welfare over time. I'm certainly not a log cabin, go live back in the woods in a log cabin guy. I like stuff too. But we also need our markets to be creating jobs that are going to allow people to support their families and do that whatever their aptitudes are, ideally do that wherever in the country they are. We need markets to really be supporting innovation, to be supporting productive investment. We need them obviously to be competitive in a way that creates the right incentives for new businesses to form. And so I think when we start to ask along all of those dimensions, are markets doing what we need them to do to generate the kind of prosperity we want in America, that is sort of capitalism's promise and the reason we all buy into the system, I would say certainly in recent decades that it is not working very well.
Well, let me probe you on that and start with kind of a neoliberal foil and then go back in time to classical liberal ideas. So on the neoliberal front, it is true that people like Nobel laureates Hayek and Friedman would have more or less said what you just said about markets. Their goal is to produce the most efficient outcomes. I think it's also fair to say that both of them assumed government was doing what it's supposed to do correctly, that it's providing public goods, it's doing social insurance, it's doing all those things. And of course, that it may not be doing. Classical liberals, on the other hand, really, while competition is the touchstone of Adam Smith, the idea that everybody is in the boat together and we all need to be able to compete seems like a fundamentally liberal idea. So did neoliberalism take a wrong turn? Is classical liberalism still relevant to this debate?
Well, I'm much more sympathetic to the classical liberal view. I'm trying to reclaim Adam Smith from the economists in a sense. I always remind
I'm
people.
holding on with dear life. By the way, this is the 300th anniversary of Smith's birth year. We're going to have another one of these conversations on Smith at 300 in just a few weeks.
Excellent. So I profess to be a huge Adam Smith fan and emphasize that he is a political economist first, not if there even was such a thing as an economist at the time. And I think a tremendous amount of what he got right and has since gone wrong, you can find right in The Wealth of Nations in the paragraph where he talks about the invisible hand. Everyone knows the invisible hand thing, everybody quotes the invisible hand thing. If you look at what Adam Smith actually writes about and describes as the invisible hand, first of all, he leads in with two prerequisites. So first of all is an assumption that people are going to prefer domestic to foreign investment. He actually spends a lot of time talking about all the reasons people are going to prefer investing domestically to sending their capital overseas. Second, he assumes that the things that are going to be the best uses of capital, that are the most profitable, are also going to be the things that lead to the most employment and generate the highest levels of output. Only after establishing those two things does he then say that if those things are true, then when people pursue their own private interest, as if by an invisible hand, they will be advancing the public interest as well. So the invisible hand is not some magical principle that whatever people are out there doing to pursue profit also works well for everybody. It's almost more of a truism that if the things that generate the most profit are also the things that are good for everybody, then people pursuing profit will also do so in a way that is good for everybody. He wasn't making some extraordinary prediction or laying down some law. He was describing why the system did in fact seem to be working. And I think that's exactly the right way to think about capitalism and to understand markets. What I would say the neoliberal economists got so wrong is that I think that got twisted into a much more blind faith in markets. Hayek in particular, he has a very famous essay actually called Why I Am Not a Conservative, which is what makes it so funny that so many conservatives picked it up and ran with it. Hayek specifically credits what he calls the self-regulating market and says we don't necessarily know what these forces are, but if you're a true liberal, you just have faith that they will in fact generate good outcomes, bring things into balance. And he was empirically wrong. One of the nice things about Hayek is he does make predictions. One of them is that imports and exports will naturally come into balance. And of course, we are now running $1 trillion annual trade deficit. Friedman, I think likewise, I think Friedman gets more of a bad rap. To your point, he had a lot more to say about social insurance and so forth. But at the end of the day, he's best known, at least in our circles, I would say, for his comments on business and the idea that the social responsibility of businesses is to make as much money as possible. And he didn't even necessarily say it this way, but that became businesses, by making as much money as possible, also advance the social good. Not clear to me he actually was saying or believing that. It's definitely not clear to me that that's true.
Yeah, I think what he said, this is a very famous piece actually, it was not academically arcane. It was in the New York Times Sunday magazine. He made the bold claim that Oren mentioned, but if you read the fine print, he's basically saying if there's competition everywhere and government is doing its job perfectly, then business should do X. And so the question is any of that true? The argument actually works okay as long as every assumption is true, but I'm not sure it really is. I want to ask you another big picture question. Capitalism, is not popular with wide swaths of the public, particularly younger people. When I teach modern political economy at the school, I will often refer to a political economy classic, the Monty Python movie, The Life of Brian, where there's the question of, what did the Romans ever do for us? And then there's this long list of things that the Romans ever did for them. And I say to the students, that's capitalism. It has done a lot of things. That said, it's not popular. So you mentioned work before. What are the one or two things you think that are causing this public discontent with capitalism? Is it a draw to socialism? I don't think so. I think it's something else. But what do you think?
Well, I think it's a very real recognition that capitalism is not working as advertised. And I think you have to sort of separate the baseline. You always have young people who don't like capitalism or whatever the regime is. But I think you see something more than that, and I think it extends further from the young idealist years into, I don't know if I count as middle-aged at 40, but into certainly people into their professional lives. And I think the crux of it, what people are seeing is two things. One is, if you just look at what is going on in the economy, in financial markets, it seems clear, at least to me, and I think to a lot of people, that what is happening just does not match the description of capitalism. So a classic example that I like to focus on is the question of who owns companies. And this goes back to the Friedman idea that, look, if you're a manager in a company, you serve the owners of the company. What the owners want is to make as much money as possible. Therefore, you should be focused on making as much money as possible. That's all well and good. If you look at a publicly traded American company today, it's frankly completely indecipherable who actually owns it. I mean, who is Tim Cook reporting to? He's reporting to a board of directors. Who actually appoints the board of directors? To some extent, it seems more like Tim Cook kind of, I mean, it seems like you have management appointing the directors to some degree. In theory, shareholders are supposed to vote, but who are the shareholders? The top owners of Apple stock are these large institutional investors, BlackRock, Fidelity, et cetera. They don't actually own the shares. They own them often in index funds on behalf of some combination of other institutions, endowments,
and
pension
everybody in this
funds,
room. Yeah.
et cetera, or on behalf of individuals. But even the individuals typically don't actually own Apple stock. They just own the S&P 500. So they own Apple and all of Apple's competitors and are totally indifferent as to how Apple does compared to them. Meanwhile, about 50% of US equity is now actually held by overseas. So now you've got, well, what share of Apple is actually held by, the United Arab Emirates Sovereign Wealth Fund? And so even if you try to take capitalism seriously and say, yes, we've got capital and capital gets invested in businesses and those businesses, that's just not what is actually happening right now. And I think that then comes up in all sorts of very concrete ways that rightly perplex people, whether it's these fights over things like ESG, whether it's when you see a lot of the investment activity from private equity funds and so forth. This is just not what you actually learn about in economics class or what you think was promised. And then the second piece of it is just when you look at the outcomes. I think you're exactly right about that list of things you could run down. I think it's a lot harder to make that list in the recent era.
Let me ask you on that very point. I think one of the things that is disquieting, perhaps, about modern capitalism is a lack of focus, and you could blame government, you could blame business leaders, but let's just get the problem out there first, on the ability to compete and everybody having opportunity. So in an economy that has, if you mean by the recent era, the sort of tectonic changes from technological advance and globalization, those have made the world of possibilities enormous for everybody in this room. They have been a challenge for some others. And while it is absolutely true when your Econ 101 professor told you they'll make society better off, that is an on average statement, and it is true. It is not necessarily true that it makes everybody better off. What specifically could we be doing better to bring opportunity back? back to make sure that everybody has the ability to compete in that economy. Because if we don't do that, we will have naysayers saying, well, let's throw it out.
Well, and in a global economy, it is not even true that it is on average better for everybody in America. And I think a huge problem, and not to pick on the fine students of an elite business school, but to use
pick on me on their behalf.
To use it as an example, let's go back to Adam Smith and the idea that we want people pursuing profit because in doing so they are going to do things that create a lot of value for everybody. Let's think about what the top things that people at elite business schools go and do. I believe the top career is still finance. I don't know if that's true at Columbia.
No, it's really tech and consulting or the top.
When was it? 2019, Harvard and Stanford were both finance, if you combine VC, private equity, hedge fund investment bank. Consulting is interesting, sort of hybrid, which as it operates today, I would argue, is certainly finance adjacent. But generally what all of those careers have in common, and we could talk about VC, which is the smallest piece of all of it, but generally what those careers have in common is trying to generate a tremendous amount of income for yourselves while doing as little actual productive activity in the real economy as possible. I think even the term investment has become very confused in America. We think that if you buy something, that is an investment. It's not actually, it's an asset swap. You have given cash, someone else has given you equity, let's say. Certainly if you're in the secondary market, even if you're doing a private equity transaction, the investment doesn't actually mean any capital is productively deployed in the real economy. In fact, to a large extent, the models tell you that the best way to generate the most money is to find things you can do that will require the deployment of as little new capital into an enterprise as possible. On top of which, the second question would be, well, are you doing something that creates any jobs, and particularly any jobs in America? And again, for decades now, some of the most profitable things you could be doing was, one, figuring out how to outsource and offshore, employ fewer Americans and more cheaper people elsewhere to do your production, or just figure out how to do less employment at all, right? If you think about the sort of, even now if we're talking venture capital, the Silicon Valley unicorn model, which commands such a huge share of venture capital investment, that's not a model that says we are going to create the most socially impactful enterprise possible. It says, what's the extremely speculative thing we can do that actually is going to fail in most cases, but in some cases is going to scale up so quickly with so little need for capital or labor, and ideally into a monopoly position that's going to generate huge rents that we get the returns.
Because I have a much more sanguine view of what financial services do in developed economies, but what does any of that have to do with bringing opportunity to people? So how do we prepare people for the jobs of today and tomorrow, and not talk to them like we wish it were 1955, because it's not going to be.
Well, the question is, what opportunity are we creating? If you are working in finance, what opportunity are you actually creating for the typical American worker?
Technology sector. There are lots of sectors in the American economy. Do you think we're doing a good job of preparing Americans to be in those sectors?
You mean like to be computer programmers? I think we have a tremendous mismatch between the skills not only that American workers have in a lot of cases, but that they plausibly will attain and can use productively in the economy, and the kinds of things that we are creating jobs for in the tech sector in particular, which leads to this sort of bizarre, in my mind, complaint of labor shortages. I find nothing more insufferable than the extremely sort of pro-market, pro-enterprise person who develops a business model that requires labor that is not available in the labor market at a price he is willing to pay, and then turns around and said this is a labor shortage and a problem that government somehow has to solve for him. It's a bad business model. Sorry. So just to expand on that a little bit, the secret sauce of capitalism when it works is when you put capital and labor together in a room and say you're only going to be successful together. Labor obviously needs capital and the investment, and to your point about all the good things we tell the story of what the finance industry should be doing. And capital really needs labor, because all of the money in the world doesn't accomplish anything if you don't have the workers to do it. And that mutual dependency, I think, is at the heart of what has worked for capitalism when it has generated good outcomes. I think what we have today is a total disaggregation of those two things, such that most of the attractive ways that capital, and to the extent you want to call sort of very highly educated, high income folks labor, what they are doing to maximize their own outcomes is completely divorced from anything that would actually create any real opportunity or would lead to them actually doing the things that helps people take advantage of that opportunity. And so the core question, I think, has to be, if we want capitalism to work for the typical American, if we want both to be having people focus on equipping them with skills, matching that to jobs where they can be productive, seeing rising wages and productivity over time, we have to find a way to force those two things back together. And that's something that markets do not do of their own volition.
Well, let me ask about an alternative, because I know you've written about manufacturing jobs as being good jobs and the notion of protecting those manufacturing jobs. Who decides what a good job is? You know, one of the things I find is that many jobs that people want today didn't even exist when I was their age as a labor market entrant. So why should I believe that protecting manufacturing jobs is good for America?
Well, the manufacturing sector in particular, I think, has a few really interesting properties. One, as you said, is that it tends to offer relatively good jobs for relatively less academically skilled Americans, certainly. It tends to do that in a very distributed way, because the same forces of agglomeration that push tech or finance into a few cities do not work in manufacturing. Manufacturing investment tends to have a much higher multiplier associated with it in terms of supply chains and related services. And so purely from the sort of job perspective, the argument isn't, well, manufacturing was nice in the 1950s and I liked the 1950s. It's that there are objective properties of some jobs that bring with them spillovers, positive externalities that other jobs don't. And so being indifferent between call center worker and manufacturing worker is not good economics even. The second thing I think is really important to say about manufacturing, and why I think there's rightly a lot of focus on it, is it's not even just a matter of the number of jobs in factories, let's say. I think people rightly point out, look, we obviously have a lot more automation than we used to.
Right. Globally, productivity is rising in manufacturing.
Well, so this is an interesting point. Do you know where manufacturing productivity is not rising? In the United States. Manufacturing productivity, not growth, absolute manufacturing productivity in the United States is lower today than a decade ago. We need more workers in factories for the same output in 2022 than we did in 2012. And so that is a screaming red siren in my mind that says something is extremely dysfunctional here. There is no, I don't think you can tell a story about a well-functioning economy where investment is flowing toward what are actually socially useful and productive outlets, where you literally have productivity declining in your manufacturing sector, especially during what is supposed to be this sort of revolution in IT and automation and now even AI. So ideally what you do want to see is much higher productivity gains in the manufacturing sector. And this is another thing that's really good about manufacturing sector jobs, is in theory you can get those gains, right? Manufacturing is a place where bringing huge amounts of capital to bear can hugely increase the productivity of labor there. It frankly takes about as much time to cut somebody's hair as it did 500 years ago. So if you want that...
I have less hair, it actually takes less
well, that's
time
individual
now.
person, that's right. You have to, that's right, adjusting for the demographic shift. If you want that barber to be able to live a 21st century standard of living, it's not because he's cutting hair 10 times faster, it's because he's cutting the hair of people who are 10 times more productive. And so this is a whole other sort of reason why manufacturing is important is because in a well-functioning economy, I would argue, you're getting a huge amount of the sort of foundational productivity gain in that sector.
The question, I think, the sort of fork in the road is, should we do more to make sure U.S. manufacturing is not disadvantaged? Should we do more to help people access opportunities in manufacturing? Or do we need a board in Washington that's going to decide which jobs are good jobs? I mean, let me ask you to grade what the Biden administration is doing in industrial policy. Our national security advisor gave a speech about yards and fences and industrial policy. Is this what you're talking about? Is that how we're going to do it? How do you grade what the administration's trying to do?
So, I mean, Biden administration, I think, has been a really mixed bag on this. I think conceptually, they've made some very good progress over, say, the Obama administration in recognizing that for markets to function well, for them to generate the kinds of outcomes we want, we actually do need to have some perspective on what is going on within the markets. And so that's where you get to something like industrial policy and a focus on something like semiconductors. I think the semiconductor focus is exactly right as an example. And there it speaks to the third area where manufacturing is so important, which is as a sort of driver of innovation more broadly. One of my favorite essays and points in particular is from Andy Grove, the longtime CEO of Intel, wrote a really important piece for Business Week, I think in 2010, where he talked about the problem that he saw at that point with what was now going on already for a decade or two in the US economy, specifically in terms of Silicon Valley, and saying, look, engineers are trained to optimize things. They're working at firms that are trained to maximize profit. And a lot of times the way to do that is to move your manufacturing offshore, especially in a context where a Taiwan or a China is subsidizing your fab so that it is 50% cheaper to build. Well, 33%, 50% more expensive here. And that a lot of economists, I think, were saying, like, that's fine. If it's cheaper to manufacture there, that's where they should do it. The problem is that the innovation and the ability to scale ultimately follows the manufacturing capacity. And that if we just take this attitude, the sort of designed in California, made somewhere else, that sounds great in the short run, it is disastrous in the long run. And I think he was proved exactly right in chips in particular. I mean, Intel is now several generations behind the cutting edge. We cannot make cutting edge chips in the US. And when you now start to do these big investments from the Biden administration, with bipartisan legislation in Congress being implemented by the Biden administration to start to rebuild fabs in the United States, you start running into this problem where no one even knows how to do it anymore. And so looking at something like semiconductors, where you say, look, this is sort of a keystone technology for national security, for everything that is going on in artificial intelligence, all the ways we expect technology to develop, it is something we need to be good at. And in a hypothetical free market where everyone was just happy with the free market, maybe you would say we have a comparative advantage there and we would be good at it. The reality is that in the global economy as it is operating, where other countries look around, try to figure out the high value technologies and attract them, if we say, well, as free market people who don't believe in government boards, we're not going to have a point of view on that, then the end result is we end up with the stuff nobody else wants. I think there was a point around 2010 or 2011 where scrap metal was literally our largest, at least ag aside, export to China. We went from having about a $60 billion surplus in advanced technology product exports at the end of the Cold War to a $200 billion a year deficit in advanced technology products today. And it's not because Taiwan has a comparative advantage in semiconductor fabrication. It's because of differences in government policy. So even if our ideal is nobody has a point of view, we just let the market do it, in the real world, I would say that's just not an option. And the good news is I think actually this is a place where government has a role and can do it fairly well.
I would agree with that. I think that government role is probably better done through large research subsidies and applied research centers, but I would agree with that. But I do want to take you to China, because I want to make sure the audience gets a chance to talk with you. But de-risking, decoupling, what should we be doing? So if you think about our relationship with China, partly this is a national security question. Smith himself said that national security is a bona fide reason for intervening with openness. The previous administration used national security against Canada, so I think the argument can be pushed maybe a little too far. Do we have a national security case here, and where should we take that with China? And should we be doing more? How should we think about Chinese trade?
Well, I think we certainly do have a national security problem. I would say that casts it much too narrowly and almost provides like an easy out. It's like, we have this China problem, well, I'm going to acknowledge we have a national security thing, and therefore I've cabined the problem. And it seems to me that the problem with China, and it's interesting to think about, like, what would Adam Smith have said about trade with China? I find this a fascinating question, and there's no answer to it. But it seems to me, if you start looking at what it actually entails, the fundamental problem is that it meets none of the criteria for free markets or free trade that Adam Smith was making a case for. And China, obviously you have countries all over the world with all sorts of different economic and political regimes. Generally, the United States has been the massive actor and could impose its will to some extent, or didn't care too much about what some other country might be doing. When you have a near peer-to-peer scale economy, 1.4 billion people under a sort of an authoritarian government and a state-controlled economy, and you say, well, we're for free markets, so our market should be open to this economy, right? If you think about genuine free trade, let's get rid of the barriers, we're basically saying our market the boundary of it should encompass both of them. If you do that, you're accepting every distortion that the Chinese Communist Party chooses to implement into your market.
But I'm asking, what do you do about that? So let me be concrete. So one idea is, doesn't sound like they're playing by World Trade Organization rules, so maybe they don't get to be treated like that. Is that what you're saying? Is it something else? Are you saying don't trade with the Chinese at all? I'm just trying to figure out what the punchline.
So the reason I'm describing this is to say that what you have here is, it's not just about like breaking the rules of free trade. It's that you have two incompatible economic and political systems that a weird, I would argue, misunderstanding of everyone from Smith to Friedman and Hayek led us to believe, well, let's just sort of have free trade anyway. Now, part of the argument was, by doing free trade, we will bring them along and they too will become a free economy. It's a really interesting question. If you go back to 1999, 2000 and tell everybody, actually, China's not going to liberalize, they're going to become more authoritarian, what do you think? Maybe people start to think we shouldn't have done this in the first place. But given where we are, you just have fundamentally incompatible systems. I don't think you can actually run either a capitalist economy or a democracy at the end of the day when you are attempting to operate an economy, half of which is state-controlled by a communist party. So, what we talk about American Compass is the idea of a hard break from China. But I think our policy should look an awful like it did with the Soviet Union. There was no trade with the Soviet Union. There was no investment flows. There was no ownership in each other's economy. There's an incredible story in the mid-70s. PepsiCo, after 13 years, finally managed to open a bottling plant in St. Petersburg. The Russians had to pay for it with vodka because the currencies weren't even exchangeable. And that strikes me as the only way, if you are actually serious about everything we like about capitalism, that we like about our democracy, that we say we believe in, that is the only sane policy. And so I would say, frankly, sending stuff back and forth on like products on boats is the least concerning part of the relationship. But there should be no US ownership or investment or joint ventures in China with Chinese companies. There should be no ownership, investment, joint ventures of Chinese companies in the United States. there should be no research partnerships. There should be no, in particular, we should not have our political, cultural, and business figures attempting to do business there and make a profit there, because as we have seen, the result is they will allow themselves to be censored by the Chinese Communist Party.
To remind, there is a big difference between the Soviet Union and China. The Soviet Union was never plugged in to the world. China is about the most integrated. Unwinding China is a whole lot different. I do want to get to questions. Can you pass your questions? I don't know if somebody's going to collect them. If that's too hard, I'll just start calling on people. I have a couple, but I want to make sure we give some time. Anybody got a question they want to hand there? While we're waiting, somebody ask a question. Anybody got one? Yes, ma'am.
The more we manufacture, the more we make trash. The more trash we make, the more we are likely to annihilate human species through fires and floods. Is there any way to reorganize our system so that making less is still sustainable economically as well as for the...
Okay, let me repeat, because probably people didn't hear it. I'm going to put it in econ speak. There are negative externalities in manufacturing with, you could call it environmental degradation, lots of things. What do you think about that? In your manufacturing?
Well, and I mean, if we're taking it in the climate context in particular, there are far higher negative externalities to manufacturing things in developing countries like China than manufacturing them here. So everything that we make here instead of in China reduces the overall carbon footprint. More broadly, I don't think we can look at the manufacturing sector and economic production broadly as a net negative. If we do, everything collapses, just in terms of economic theory. And so, we could have a much longer discussion about climate change. I think there's a lot of effective climate policy we can pursue, but I think anything that we do to pursue it that requires us saying we don't like manufacturing or we want to voluntarily deindustrialize is going to be totally counterproductive and lead to a loss of democratic legitimacy and our capacity to deal with any of these problems far before we actually solve them.
Now we agree on something. Good. So let me ask some questions from the audience. How can government policy strike a balance between promoting economic growth and ensuring social safety nets for vulnerable populations?
Well, so I don't see those things as incompatible at all. I mean, at the end of the day, you have to raise tax revenue to pay for these things, and some folks would say that raising taxes interferes with economic growth. So I guess there's some trade-off there. But there's certainly no reason we can't do both. I think when we run into a problem, and this comes back to the emphasis on work you raised at the beginning, is when we start to tell ourselves that for folks who are falling behind, for folks who do not have opportunity in the economy today, we could just choose a better safety net over actually addressing the economic problems. And I think that was a big part, I think it is a big part of neoliberal doctrine, this idea that, well, we're going to create winners and losers, but the winners can compensate the losers, and therefore everyone is better off. And the reality is that is not a good trade from the perspective of those who are being told that they're being compensated. The right way to think about whether our economy is actually delivering is not just aggregate economic growth, which just takes a single number without respect to distribution. It is to ask whether we are getting a kind of economic growth that is broadly distributed. And if you do that, that's not only compatible with a social safety net, but it requires less of one.
Yeah, to add, Oren and I were talking about this before we started the conversation. An emphasis on work would mean using social programs more to bolster work. We do have programs like that in the United States. European economies use labor demand subsidies. We have something called the Earned Income Tax Credit. We could be doing a lot more to reward work. I think both of us were sharing some skepticism that simply giving people universal basic income is a good idea, in the sense that it doesn't really promote inclusion in society. One of the things that classical liberals like Smith believed is inclusion in society is important. Everybody wants to belong. My colleague in the economics department, Ned Phelps, a Nobel laureate, refers to this as mass flourishing, and I think he got it exactly right.
I want to throw in one other thing about this, which, I'm a big fan of some sort of wage subsidy, which Professor Phelps has written a lot about as well, particularly as an anti-poverty program, helping folks at the bottom get into the labor market, making work pay more is really important. I think it's important to recognize that nationwide we have a much more structural macro problem, and this is something we've just done some research on that I was really stunned by, because when the Bureau of Labor Statistics does employment data, the unemployment rate, we basically just count how many jobs we have, right? Oh, we got 200,000 new jobs last month. And we don't really ask anything about those jobs. So we surveyed just 1,000 workers. This is not 50,000 a month or whatever BLS does, but 1,000 workers, just tell us about the basic characteristics of your jobs. And we set a basic threshold for what we would define as a secure job, which we wanted to be very basic. We said $40,000 a year, full-time, with health benefits and some paid time off, with predictability in your schedule and what your going forward earnings would be. Only about 40% of workers in the economy had a secure job. And among those without a four-year college degree, it's only 30%. And so you can build incentives to try to get people to take the jobs that are there and even get more money into their pockets when they do. But going back to this broader, is capitalism working? Our economy is not generating within tens of millions of the number of secure jobs we need. And so I think as policymakers think about how do we create opportunity, it's how do we create an economy where the types of jobs that get created that are compatible with profitable enterprise are secure jobs.
Here's another question going back to the conversation about China. Is it possible to cooperate with China, e.g. continue to outsource manufacturing to China, even with a drastic difference in political systems?
It's possible. I would say it is unwise. When we do this, a few things happen. Now, one thing to distinguish, I think, is balanced versus imbalanced trade. So in a hypothetical world, we could have very high levels of trade with China. They make tons of stuff for us, and we make tons of stuff for them. Jobs that were previously done in America are now done in China because it's cheaper there. But things that China might otherwise be making for itself, we make because it's, for whatever reason, relatively better to do it here. That's the model of trade that Adam Smith and David Ricardo were talking about. Adam Smith specifically describes the kind of trade that is mutually beneficial as exchanging some part of the product of our output for the output of the other country. When you have a large deficit, and this is why I would argue trade deficits matter, when you are running $1 trillion trade deficit, what that means is China is making a massive amount of stuff for us, much of which we would otherwise be making here, but rather than exchange that for stuff from us, they're not giving it to us for free. Instead, they take back our assets in return. They take back corporate equities, they take back corporate and government debt. And in the short run, you could say, well, that's great. We get to consume a lot of stuff and we didn't even have to make anything, right? What could be better? You can believe that and simultaneously believe that in the long run, that's absolutely catastrophic. And I think this is one of the places where economists and business leaders actually tend to see things quite differently. And I'm with the business leaders. I mentioned Andy Grove talking about losing the innovative capacity. A key part of what he says, look, if you want to prevent this, you basically have to put a tariff on offshoring and re-importing because it is socially disvaluable. You want to discourage it. Warren Buffett, when our trade deficit was first exploding, wrote about this specific problem of basically mortgaging your future. You are buying stuff on credit even as you erode your own capacity to pay it back in the long run. And he basically said this is an intolerable long-term trajectory for an economy and proposed, there's some twist to how he designed it, but said we should have a global tariff. Basically the exact same thing Trump just proposed.
Let me put myself in before I go back to the student questions on that, because I remember Warren Buffett is by far our most financially successful graduate. I once said to him, you're the Warren Buffett of investing, but you're not the Warren Buffett of economics. Exactly on that argument. So bilateral trade is not the same thing as the nation's trade balance. So by arithmetic, if the US is running a trade deficit, it has investment in the economy greater than savings. So when you say you'd like to bring that trade balance to zero, which of those variables do you have in mind moving? Investment or saving, and what are the implications of that?
Well, so a couple things. First, totally agree on the bilateral deficit point. And I think people rightly talk in terms of China because that's where so much of the imbalance is tangible. At the end of the day, the economic problem is the global imbalance. And you see this with the Trump tariffs, where Trump put tariffs on China. Those tariffs were actually very effective in shifting production out of China in those things that the tariffs were on. They did not return the production to the US. They had no real effect on the trade deficit.
When US consumers paid for the tariffs. I mean, the evidence
Some
on the
share of
tariffs, the evidence here at Columbia, Amit Kandawal, David Weinstein, they basically paid for all of it. But anyway, you're going to explain how we're going to bring the trade balance to
So
zero.
if you have the global, if you're thinking about it as a global tariff, and this is Warren Buffett's proposal, he wasn't talking about targeting China.
Correct.
He's talking about the overall balance of imports and exports. The question of where does that balance land, I'm fairly indifferent to. Other things equal, if we could have high levels of trade and have it be balanced, then you're back in the world Adam Smith and David Ricardo are talking about, where different countries are doing things where they actually have comparative advantage, and you expand the consumption horizon for both. That's great. If it turns out that when you force in trade toward balance, other countries start to get less excited about the levels of trade that we have as well, and you start to see relatively low levels of trade, I would say that's also preferable to the imbalance we have now. And the last thing I'd say about it is the response you will often hear, and I think you gestured at this a little bit, is, well, you know, the flip side of our trade deficit is an investment inflow. And this is how it gets talked about. We have a trade deficit because the world wants to invest in America. And to me, this goes exactly to this misuse of the term investment, right? Because when China takes back, let's say hypothetically, or the world takes back $500 billion of US Treasury debt in return for the products it has sent us, that is investment in the economic identities. That is not investment in the sense of new productive activity being sparked in the US. That is financing of the US budget deficit, which often goes straight into entitlements, right? So it's not necessarily actually creating any investment that is good for our economy at all. And if you look at flows of even foreign direct investment, they actually, a little while ago, Bureau of Economic Analysis started breaking out, okay, how much of the flow of foreign direct investment is actually greenfield investment, using the money to actually build something new in America as opposed to just the asset swap where you're just buying something that already exists here. Most years it's 2 to 4%. So when we hear, oh, the world's investing in America, we picture like Toyota coming and building an auto plant in the US South. Wouldn't that be great? Only reason they did that was because Ronald Reagan put a quota on the imports of Japanese vehicles, a massively interventionist, protectionist policy. Generally speaking, that is not what we mean when we say investment in America. What we mean is these exchanges in which existing US assets are flowing overseas in return for stuff that we consume.
But it is nonetheless the case that American consumption and investment will have to fall just by arithmetic. And maybe you say that's fine, but that's
how much?
That's math. So,
which has to fall?
Well, consumption or if I'm going to bring investment down or saving up. So I'm going to cut investment or I'm going to cut consumption and cut it by a lot and cut it all at once. So anyway,
well, we're not going to do it all at once. Anything you do would fate, right? We're not going to a zero trade deficit next year. Any reasonable policy, I think, phases this in over time. Mm-hmm. And so I think one thing you then have to look at is what is the actual dynamic effect here over time? Because I think you had this, what's called supply side revolution with Reagan in the 1980s, where economists rightly pointed out, look, we've been thinking of a tax cut, let's say, as just, well, the tax rate is lower, so we get less revenue, the end. we need to think a little bit more broadly about what the implications of the tax cut would be for economic activity and investment and the long-run trajectory of the economy, and that could actually be very positive. It seems to me you have to ask the exact same question when you're looking at the ways our economy has gone out of balance in ways that I think have been very destructive to actual productive investment within the country. And so if you tell me the purpose of the policy is actually to be importing less, to create quite large incentives to do more investment in building things domestically, in the process actually there's a whole sort of federal budget deficit piece of this, which I think you have to address as well. It seems to me the actual trajectory you're putting the economy on is a much more positive one.
Let me just do a quick lightning round because our time is almost up. What's one big idea that you would like Washington to put an emphasis on to shift capitalism in the way you would like? And then I'll give you one too, but you go first.
Well, we've talked about this, the trade issue, and I think a global tariff is in fact an appropriate policy, and it should ratchet up proportionately to the trade deficit. So to the point about it not being all at once, if you started at 10% and you say, look, every year where we are still in deficit, it's going to go up 5%. And so everyone, including investors, has very good predictability and foreseeability that this thing is going up, the relative prices are going to shift over time, and you actually want to be investing in creating that domestic capacity. So that's one, but I'll take a second because we were already talking about that one. I think we also need to just crack down on whatever on earth it is that's going in financial markets. That's extraordinarily unproductive. And I think a financial transaction tax would be a very good way to do it. London has one, Hong Kong has one. For a comparable cost of doing one in the US, you could fund a huge capital gains tax, you could do permanent expensing, and shifting the tax burden off of actual productive long-run investment into unproductive short-term speculation, I think would be hugely beneficial.
Well, I'll give you mine, but let me just do a quick Econ 101 reminder on the financial tax. So that's like raising a transactions cost that will be capitalized in the value of assets. So the incidence of that tax, so everybody in this room, that's just the Econ 101.
Of course, but if you offset it with a capital gains tax cut, what's the net incidence?
I'm all for capital gains tax cuts.
Well, but that's what I just said, right? This is one of the problems. Sorry, you still get to do yours, but I have to rant about this for another moment because we were just dealing with this. The Tax Foundation put out a report on Trump's tariff proposal. And they said this thing's catastrophic, it's $300 billion in new taxes, it's going to tank growth, it's going to destroy 100,000 jobs. I said, what do you assume happens to that $300 billion? And they said, we don't model that. I said, so you mean if Trump had said, well, I'm just going to set the $300 billion on fire, you would have come up with the same answer? And they said, yes, that's how we do our tax modeling.
And so I'll let the Tax Foundation defend itself. But my idea is that I think we need to have much more of an all-of-government focus on opportunity. I expect one of the reasons protectionist voices are becoming as loud as they are and as prominent as they are is we have failed. And I think asking the markets necessarily to do that is not the right answer. This is a government problem, and the government needs to be on it. And I think part of our problem is we've had elites on both sides of the aisle basically looking past the problem. So I think that's
not a policy idea. What's the policy idea?
Well, the policy idea would be everything from massive wage supports to massive support for community colleges, to public-private partnerships and research. I think there's many ways you can make that. You can make that flesh, but reaching for the protectionist model.
But how does that differ from current policy? I mean, we give
We're not doing any of that.
Look at what we spend on higher education right now. We spend about $200 billion a year in public money on higher education.
But not so much in community colleges.
Well, a significant share goes to that. I mean, the reality is that most Americans don't earn even a community college degree. Certainly one thing that I would focus on much more heavily is non-college pathways and recognizing that we need to be focusing much more there. But yeah, I would strongly challenge the idea that we don't, to sort of, they're all the sort of economists' correctives to the more protectionist agenda. I think the reality is that this sort of default, let's invest in opportunity agenda sounds to me like exactly what the agenda has been for the last 20 to 30 years. This has been the pitch, and I think in particular, it's funny that we'll be on these sides of this, but it comes back to where we started on the question of whether markets are working well. When you say that you feel like this is something that government needs to do, I disagree with that. It seems to me that a sort of core priority for people who like and support markets, people who are skeptical of sort of bigger government as the way to solve problems, is to focus on the fact that we do want markets to do these things. That those are the choices, right? You have sort of progressives are happy to criticize capitalism and say, yeah, markets aren't going to do this. That's why government has to step in. You have the libertarians who say, well, markets just, whatever the market delivers is the best thing ever, so let's all go home. The role for conservatives, I think, is to say, no, we want markets to be the way that we accomplish these things. We know that markets can accomplish these things. Markets have accomplished these things in the past. Why aren't they accomplishing them today? And what can we do to get them accomplishing them again? And I don't see how we're not spending enough on higher education can possibly be part of that. That's not where capitalism has broken down. I think we should demand a lot more of capitalism.
Okay, I want you to join me in thanking Oren. We've got some clear fault lines, but an important subject.
Thank you very much.
Thanks so much.